next speaker today has been involved in the Canadian financial markets for over 30 years. He has extensive experience in small cap evaluation and investment, so he's here to share his thoughts today on the cannabis market. Please welcome the CEO of Quinsam Capital, Roger Dent.
Hi, everybody. Thanks very much. All righty. Well, I'm going to spend just a few minutes talking to you a little bit about Quinsam Capital. Quinsam Capital is a publicly traded company. We trade on the CSE ourselves. We are an investment fund. So basically, we are a specialty vehicle for investment in the cannabis space. So just start off with a few just kind of basic details about the company. We've got about a $50 million pool of assets. It's virtually fully dedicated to cannabis at this time. We trade slightly under our asset value on the CSE, so we're a way to buy cannabis companies at less than the trading value. We also offer a dividend, which we've had in place for 4 or 5 years now. Just by way of background, Quinsam has been a public company for quite some years. I got involved with it in 2014. Myself and a group of other people took it over because we were interested in having an investment issuer. It offers, as someone who's investing, some great advantages versus typical fund structure. Most importantly, it allows us to invest with flexibility in earlier stage companies, and in the cannabis space, that's a huge advantage versus conventional sorts of funds, because it basically allows us to get into some of the more exciting opportunities without all of the limitations that come with a mutual fund. We've been investing in Quinsam for about 5 to 6 years. History significantly before that, but about 1.5 years ago, we decided to become fully dedicated to cannabis. Some detail on our share structure. We do, because of the way we raise funds, we've got quite a lot of warrants. And this is one of the things that's probably caused our price to be a little bit stuck in the 30s right now, because when we do get a movement, we tend to get warrants coming in. But one way or the other, the warrants will work their way through the system in the course of this year. We think that the way things are looking, that they'll get exercised and we'll just move higher. The team managing the company, there's 4 of us that are on the management front. We've got a good team, but because we're all involved with other things professionally as well, we're able to run the company at a very, very low cost. The CFO is essentially a relatively full-time individual. He has other duties, but he costs us around $8,000 a month, and the other 3 of us together cost $15,000. So the total running costs of the company, including the public company costs, run around 1% or even under 1% of our assets. No 72nd floor offices for us. In fact, we've run the company for 5 years with no office whatsoever. So we pride ourselves on running a very tight cost structure, a very low-cost operation. Also assisting us, providing advice, 4 outside directors, probably most notably Terry Booth from Aurora sits on the board. Also Adam Schreris, who is a lawyer at Fogler's, also head of Foundation Markets, very involved in the cannabis space for quite a number of years. They provide us a lot of advice and access to deal flow, and also the ability to assist with due diligence. A little bit of background on me. I've been in Toronto for 30 years. I spent about 5 to 10 years at CIBC Wood Gundy at the outset, but I've been focused exclusively on small caps since the early 90s. So I've been doing Canadian micro caps, small caps for 25 years, and I think that as one is looking at late-stage private and early-stage public cannabis companies, that's a useful background to have. Spent about 10 odd years before this running small cap funds for matrix funds, which got bought out ultimately. Just a little bit about Foundation. Foundation is based here in Toronto. They've assisted with the go public transactions and the creation of quite a number of cannabis companies. Probably the most notable one that they're advising right now is Harborside. It's actually an important investment for us. They've done one pre-RTO financing round about a month ago, probably another one coming up in the not too distant future with a listing either in December or perhaps January. I'm not going to spend a great deal of time talking about the cannabis space. I think everyone here is obviously very familiar, but there are some very unique financing requirements that the space has, and we, because of our structure, are able to offer a whole variety of flexible alternatives to cannabis issuers. So, we buy conventional equity, we buy convertible debentures. We've also done, for example, a couple of quite creative mortgage deals where we have offered mortgages on industrial real estate here in Ontario and taken free equity in the issuers as a result. Core competencies, won't dwell on this too much, but we have the full complement of due diligence skills. The one thing I would highlight, though, in the third box is that we also sell things. So we not only buy cannabis companies, but we are not afraid to take profits, and we have probably already purchased and exited 25 cannabis companies over the course of the last year and a half. We have significantly more that we haven't exited, but one of the key things we think in this market is to know when to take the money off the table and move on to something else. So we're in a constant mode of recirculating our holdings, trying to buy them at attractive pre-IPO valuations and selling them to the public in general once they've listed. So a little bit about our performance. Before we got into cannabis, we were putting up decent numbers in 2016, well in the 20s. Early part of 17, small cap markets weren't that great. We weren't making any significant money. We decided to switch into cannabis. And for the last 5 quarters, we've been putting up double-digit returns on a consistent basis. And we're quite excited about the outlook for the fourth quarter with some of the liquidity events that we've got lined up. So a lot of these returns, they're basically generated by us buying a portfolio of pre-IPO companies and taking advantage of the go public. We think the portfolio today has a very large number of companies where we're carrying them at the private market values that have a lot of upside when they list. Plus, we also carry all of our warrants, of which we have a great deal, at either nil or intrinsic value. So if they're not in the money, we carry them at nil. If they are in the money, just at intrinsic value, no Black-Scholes value attached to them, which some other issuers, I think CGOC, for instance, does a Black-Scholes valuation on their warrants. Investment approach, I think, talked a little bit about this already. Our preference, if we can, is to be in some sort of a debt instrument. That allows us in the private company to get an exit if for whatever reason it doesn't go public. It also gives us downside protection. If markets go down, we still have the debt value. But as I said, we've looked at other sorts of things, mortgages, for instance. In terms of exposure, at this point, I would say we are now dominantly outside of Canada. We still have Canadian investments, but we are not terribly interested in conventional ACMPRs these days. We've exited a very large number of those holdings. We still have a couple, most notably probably a couple of the presenters here today. Rocky Mountain we still have Evenco. In fact, we actually were buying some Evenco last week in the market when the stock weakened. I think, already talked about this, that we carry the unlisted warrants at nil or intrinsic. And the private investments, we're essentially carrying at cost unless there's been a financing at a higher level that takes the value higher. So what we look like now, about 50 different investments. So in rough terms, we've got about $50 million, 50 different investments, so the average is around $1 million. About 40%, or maybe even a little bit more now with the acreage public listing, about 40% in the US. We've also got holdings, you know, in Israel, Australia, Uruguay, Colombia, Jamaica, and looking at others as well. About 75% of the portfolio right now are pre-public investments, and a very large number of them we would expect to be public in the course of 3 to 6 months. So Q4, we've already announced, you know, that we expect a large number of liquidity events. You know, most notably last week, Acreage listed. So we put about $1.2 million into Acreage in the spring. We had it marked at $8 Canadian at the end of Q3, and it's trading today over 25 US. So you know, we've got a $3 to $4 million gain there in Q4. Xanthic, or as it's now known, Green Growth Brands. We bought into Xanthic at a dime, which consolidated to be 40 cents about 6 months to a year ago, and you know, it's trading through $3, and we're virtually fully sold. Anyway, I think I'm running out of time, so you know, very quickly, if anyone had a couple of questions, could maybe take a couple, but if not, maybe can catch up with people later on. Okay, well, thanks very much. Oh, one question, sure.
Yeah, when you're typically buying into these companies, through the convertible debt, what kind of discount are you getting when they go public? Like, what's the typical ratio? Like, you're buying and you're getting, what, a 25% discount when you convert the debt to actual shares?
We're not a fan of those sorts of deals where you get some discount to the public listing because it locks in your maximum return. So we like to have a convertible at a specific price that we think will be a significant discount to the go public. Okay, well, thanks very much.